Bismillahirrahmanirrahim. Subject is Advanced Corporate Finance. In today's topic is Convertible Securities. This is second lecture on Convertible Security. We will discuss today forcing or stimulating conversion from the issuer sides. It is from the company side. Second is convertible value. Third topic is straight bond value, means the bond which don't have any convertible option. Means no convertible option is available on the bond. What is the straight bond value? Straight bond value of convertible means when the bond have a convertible option, what will be the value and what value should we expect at minimum. Why use straight bond value in convertible? Exchangeable bond, value of exchangeable bond. Forcing or stimulating conversion, that is when issuers or the corporation see that the market condition are favorable to recall the bond, then they call their convertible securities and pay the call price to these investors. So investor can exercise their option to convert to a common stock at any time. This is option available with investors. Now what corporations do? Corporation can force conversion by calling the issue. How? When the corporation will call the issue or call the back that we are going to buy back our issued securities, the company has an incentive to call only when conversion price exceeds the call price around 15%, and when the common dividend rate is less than interest rate or preferred dividend rate. Like for example, how? Let's suppose call price is 100 rupees. And conversion price is 120. So 20% above. So this is less price and this is more price. The conversion will cost high to the company while call up cost is less than the conversion price. So what the company will do, company have any incentives to call up their incentives. By calling up means that they will they have the choice to call back, to buy back their securities from the investor. So they will call it. Second incentive is when, let's suppose, the issue or debt or bond or preferred stock. Debt carry means interest cost to the company, while preferred stock carry dividend is basically the cost of preferred stock. So if these are high, let's suppose on dividend you are paying 7%, while on debt you are paying, let's suppose, again 7%, while on common stock you are paying a dividend 5 rupees, or 5% of the dividend price. So now common stock is basically cost low as compared to these two sources. So it is the time for the company to call up their securities and pay back to these preferred stockholder and dividend holder in order to reduce their interest cost as well as dividend cost of the preferred stock. Firms attempt to stimulate conversion by how they will when they will try to convert by including step-up features to the conversion price. Step-up feature means are increasing the common stock dividend. What the company will do, sometimes this conversion price is, let's suppose, 30, and the company want conversion that the people should convert their securities to a common stock. Then they will change this conversion price, let's suppose, from 32 or 35, like this. So they will change the conversion price. By changing the conversion price, they will stimulate the investors to change their convertible securities, either it is preferred stock or bond, to a common stock shares. Secondly, if they increase a dividend on a common stock, what will happen? It will again motivate the investors to convert their convertible securities into a common stock and in order to get this revenue. Convertible value. Convertible bond value is basically have two components. One is straight bond value, that is the bond that is normally the normal bond that do not have any convertible option, and second is option value. So these are two components of the convertible bond value. Now, volatility in cash flow of the firm. These values will, if the volatility in cash flow of the firm results in what? It decreases the straight bond value. Why? Because high volatility means high risk, and in a straight bond there is no return. It is not related to the high risk, because on a straight bond the investor just receive a coupon rate. If the company have high risk or low risk, they have nothing to do with these cash flow volatility. But these bond, if the volatility is high, means the company is risky, so nobody is willing to buy the bond of the risky company, so it will decrease the bond value. Increase the option value. Why option value? High volatility means that the cash flow is not constant. So because of this volatility, the option price increases. Option price is basically, if we talk about Black-Scholes model, there is in option pricing the lambda is the standard deviation is used as one of the factor in option pricing. So this standard deviation is basically a risk. If there is a high risk, the option will have a high value. So volatility increase in cash flow also increase the optional value convertible option. Secondly, these option value depend on the stock market price. If the company stock market is high and trading stock market is high and trading is frequently occurred in the common stock of this company, its option value will be increasing because the investor will convert their convertible security into into common stock. It suggests that convertible are useful when the company future is highly uncertain. Useful for whom? Useful for the company. If the company knows about its future cash flows that we are uncertain, they should issue a convertible bond. Why convertible bond? Because the company, when unable to pay back the face value of these bond or preferred stock, then it will start converting these convertible security into a common stock. They will need no cash or liquidity to retire their obligation. They will just convert these stock into convertible security into a stock. Straight bond value. The value of non-convertible bond with the same coupon rate, maturity, and default risk is convertible bond. Let me explain it. If the bond is non-convertible, this is the value of the bond. We are calculating the value of the bond which is not convertible. But other thing are same is that of convertible. Same coupon rate as we discussed earlier. Same maturity we discussed at the start of the long-term debt. And same default risk means the company have a same industry and same economic condition, means default risk is there if the company is unable to pay interest amount to the investor and as well as the face value of the bond. So the company are operating in the same industry in the same country, have a same default risk, and both have a same cash flow, same growth perspective, everything is same. Is convertible bond. Then value of the straight bond is, let's suppose this is a bond and which interest is compounded semi-annually, means twice in a year, semi-annually. So on semi-annually, this is interest amount paid in 6 months, so it will be divided by 2 semi-annually. This is interest amount divided by 2. This is interest amount divided by 2. So similarly, the interest rate is divided by 2 as well, because we are calculating on half year basis because the interest is compounded annually. Now for the calculation, the period is not year, the period is now 6 months. So we will divide interest rate of year by 2 and interest rate of the year by 2. Similarly, this is present, that is the value of the interest amount divided by 2, that is present value factor, and this is the last year interest amount, and this is the face value that the company will retire the bond divided by interest factor. So that is the face value, present value, interest factor, and this is what? This is the interest amount present value. So if we do not use formula, we have a table: present value, interest factor, annuity, interest, divide the interest by 2 and n, and then check in a table and put here the amount of the interest divided by 2, put here a face value, and put here the present value interest factor for a single amount, not for annuity. We will get the amount. Let me explain it with example. Straight bond value of the convertible means now we will calculate the bond value, but on straight bond value of the convertible bond, that how much it is in bond. The company C has convertible debenture outstanding that provide 8% coupon rate, interest paid semi-annually, and continue exactly 20 years until final maturity. A similar non-convertible bond will currently provide 5% semi-annually yielding to maturity. That is basically yield. What is the straight bond value of the company of convertible? We will use this non-convertible particulars while calculating the value of the convertible straight bond. Value is, now says the face value is how much? $1,000. Face value is $1,000. Now the interest amount for the year will be how much? 8% of company C. this amount will be equal to $80. Now this 80, since it is semi-annual, we will divide this 80 by 2, we will get 40. Now present value interest factor is 5% since 20 year, but we will the period will not be 20, it will be 40 because we will divide each year into 6 months. So that will be 40, that will be 5 plus 1000 face value. The present value of this face value will be, when we put a factor in table 5%, it will be a table like this. There is interest rate, let's suppose 5%, 6%, and these are years. So in 40 year, in 5% column where meet, that would be, we will put this value, we will get this value. 1000 in present value, single amount, this value, so that is $828.36. This is the value, straight bond value of a convertible bond. We will calculate their value. So the bond, convertible bond value will not be less than this amount. It is the minimum level that convertible bond can touch in their valuation in open market and the basis of cash flow. Why care about a straight bond value? The convertible bond value equal to straight bond value plus conversion option. When conversion option is no more worthy, so the people will not convert their convertible securities or bond into a common stock. So as we discussed in the first slide, that option value is also the component of the value of the convertible bond. It will become 0 when you are not exercising any option. Then is this value become, then what? It become 0. So the value of the convertible bond will be equal to straight bond value. So $828.36 represent floor minimum below which the convertible bond will not fall. This occurs when the conversion option value is essentially worthless, when the stock of the company is not attractive so much that investors are motivated and stimulated to convert their bond into this common stock, so it becomes worthless. Straight bond value is subject to change in interest rate. Obviously, the bond value, as we discussed, that is changes with the interest rate changes in the open market. Firm risk also, if the people will not buy the bond if the firm is getting risky. In time chain maturity, obviously, when there is 20 year of maturity, the bond will have one value. If there is 2 year maturity, the bond will have another value. This is in turn is likely to impact the convertible bond value. So further, convertible security offers the holder partial protection on downside, similar to straight bond based on ongoing concern and liquidation value of the firm. For example, if you have a convertible security, you are protected by downside. How? If the company on nothing, again the company is liable to pay you the interest amount as well as the principal amount. Similarly, you have a claim on asset as well in case of liquidation, so it gives you a downside risk as well, that what you can do. And similarly, convertible security also provide holder with ability to participate in upward movement of the common stock. For example, if the company grow and give a good dividend and you have an option to convert your securities into a common stock, obviously you will not wait anymore. You will convert your security in common stock. The convertible security provides holder with the ability to participate in upward movement in common stock prices. So this is the upward movement opportunities with the convertible security holder. On one side, it is protected to a downside risk. Another side, it have an opportunity to convert its security in a common stock and enjoy the high dividend and high share prices of the company. Third, the greater the volatility of a common stock price, the greater the potential gain and more valuable the option. If the common stock is trading frequently, 2 rupees below and 2 rupees high, 4 rupees high, 2 rupees, means that there is constantly activities going on in the common stock of the company. It means that shareholder value the common stock and the convertible security holder have an option, and that option have a value. He may sell this option, even an option in the open market as well. Exchangeable bond. These are the bond slightly different than the convertible bond. Let me tell you that is the parent company and that is the subsidiary company, and parent company issue a bond to share investors, and this bond have option convertible bond, but the P company said that we will not convert this bond to this company shares, but S is our subsidiary, your bond will be converted to the S subsidiary shareholders, common stock, sorry. So it is called exchangeable bond. It is issued by a parent company to investor, but it is convertible option as well, but this will not be converted to the parent company shares, but it will be converted to the subsidiary shares. It is called exchangeable bond. A bond that allows the holder to exchange the security for a common stock of another company, generally one in which the bond issuer has ownership interest, means its subsidiary or its sister concerns, so that is called exchangeable. But another company stock, that is that word make a difference between exchangeable bond and convertible bond. This is the kind of convertible bond basically. These issue usually occur when the issuer own common stock in a company in which the bond is exchanged. Obviously, this company will have their share in this company. Otherwise, how can they give an option of exchange with this subsidiary company stocks? Exchange requests are satisfied either by open market purchases or directly using the firm investment holding of the other company stock. Valuation of exchangeable bond. The investor may realize diversification benefits since the bond and common stock are from different companies. So what value can extract from this exchangeable bond? He will say that this is diversification. We have a bond of a P company and we will have a share of this company. So if the P company goes down, not necessarily that S will also go down. So there is a diversification benefit for the investor. This is an investor who have exchangeable bond and also see the company profile as well. Second is what the value investor have extracted from potentially diversification lead to higher valuation. Obviously, when there is less risk and you will value the things high. For exchangeable versus convertible bond. So convertible bond related to the same company, exchangeable bond provide a little bit diversification benefit to the investors. What is the major disadvantage in exchangeable bond? Is that the difference between the cost of bond that the investor have and the market value of the exchanged common stock at the time of exchange is treated as capital gain. This is basically called capital gain, and there may be a capital gain tax. So everywhere people are afraid of tax payment and not willing to pay the tax, so that is one of the disadvantage. Convertible gain is not recognized until the common stock is sold, obviously. So you cannot sell your option in the open market. In other case, you can sell the option that are available to you on the bond, but in this case you cannot sell the option. You will practically convert your security into exchangeable common stock. Thank you.